You are smart enough to know that investing is probably the smartest thing you can do with your money, but it's also so complicated. Doing all the research and watching the stock go up and go down and know when to sell or buy seems so stressful. I felt the exact same way until I did the research and found these 3 ETFs, and now I don't have to do any more research for the rest of my life if I wanted. I could just invest into these 3 forever and be totally fine. Hi there, my name's Nolan Govea, or Professor G. I specialize in personal finance at my university, and the whole goal of this channel is to make investing simplified. You see, I was just like you. It made sense to me that money invested would work harder than anything else because it's working even while I'm sleeping. I've also always loved business and have been fascinated by certain companies. So I took the plunge. I started researching everything and anything I could. I spent 4 to 6 hours every single day for multiple months reading every book, blog, and article on the subject. So I asked myself, what do I want? Do I want to invest, or do I want what investing can give me? The obvious answer is clearly the latter, and I'm betting that that's the same for you. I wanted time freedom and financial freedom and all the other freedoms. As I went back into the research hub, it quickly became apparent that what I wanted to invest in was ETFs. ETFs are basically a group of company stock that help mitigate the investor's risk due to the diversification of the fund. This is so easy that your grandma can probably do it. And she probably is doing it. And she's probably making more money on average long term than half of Wall Street. But I digress. This video is going to give you the 3 ETFs that you need to own. And I believe this is going to give you a perfect portfolio. For each category of ETF, I'm going to give you 2 to pick from so that you can do a little further research, which I always recommend. So there's just 3 rules you need to follow with each one of these categories. Rule number 1 is to not pick both choices within any one category. Sometimes people end up picking a bunch of ETFs within the same category, and all you're doing is stretching your money out between these ETFs, and that just leads to more stress. Rule number 2 is to make sure and figure out what you are investing for. What's your goal? More on that in a second. The third rule is to make sure you are incredibly consistent no matter what. Pick a total amount each month that you are comfortable investing and set that bad boy to auto debit. Say it's $250 every month, boom, it's there. Just $250 per month for the next 40 years comes out to over $1.3 million. And that's not even talking about the dividends and passive income. But let's not get ahead of ourselves. So real quick, going back to rule number 2, you have to figure out what is it exactly that your end goal is. Would you rather it be a super huge lump sum, but not until retirement age, so 40 years from now or so? Or would you rather something start growing in that nature, but also be able to have dividends that you're going to start seeing 10 years from now, 20 years from now? Is cash flow somewhat important to you? Or are you closer to retirement age and you do have a large amount of money that you can just invest and park and put most of that into a dividend style ETF because you're not too worried about much growth long term? You're looking at how can I make passive income today? So figure out that part, and let's talk about the 3 different types of ETFs. So the first category of ETF is the one that I always recommend that people start with. This is your foundation for literally anything in investing, in my opinion. And this would be a fund that's basically like the total stock market, or represents what the total stock market is doing. The first ETF that I recommend in this category is VTI, which is a Vanguard fund, and it's the total stock market fund. This has over 4,000 individual company stock. It has a very low expense ratio of 0.03%. And over the last 10 years, it's averaged an appreciation of 11%. The second ETF in this category that I really like is VOO, which is another Vanguard fund, and it tracks the S&P 500. This fund has over 500 company stock, but it's the top 500 by market cap in the United States. It also has an expense ratio of only 0.03%, and over the last 10 years, it's appreciated an average of over 11.5%. Now, the reason I suggest either or is what you'll see in this chart here. Looking at them together, you can see they're almost identical, though VOO has a slight advantage. Looking at the top holdings of both of them, very similar as well. Altogether, these are very, very similar, and so oftentimes I get asked, which one do I like better, VTI or VOO? For me personally, I like VOO just because I'm a business professor, and so I give a slight edge to companies that I think that are absolutely crushing it. So I'd rather have the top 500 companies in the United States than just the whole total stock market. But purely numbers alone, you can't go wrong with either of these. All right, on to the next category, and this category is growth. This one's probably the most fun and the most exciting, but it can be the most volatile. It can go up a lot, but it could also drop a lot. And I think we're seeing that right now. The first ETF in this category that I really like is QQQ, which is the Invesco QQQ Trust. This one has over 100 company stocks. It's very much high growth potential, so technology, AI, virtual reality, augmented reality, and even blockchain. It has an expense ratio of 0.2%, which is higher than the other one, but not crazy high for a growth fund. As you can see here, almost 16% average yearly appreciation for the past 10 years. So this one's been growing like crazy, and it makes sense because our technology has been growing like crazy over the last 10 years and supercharged during the pandemic. The next growth ETF that I recommend and really like is VUG, and that's the Vanguard Growth ETF. This one has over 250 company stock, so more diverse, but still heavily weighted on solid growth companies. It has an expense ratio of only 0.04%, so that's 5 times cheaper than QQQ. But it also hasn't appreciated as much at 12.9% for the last 10 years. Both of these absolutely crushed it over the last 10 years, but both of them are being beaten down pretty hard right now. So you have to keep that in mind with a growth fund. Looking at them together, again, almost identical returns. The reason for that is that even though QQQ has a higher actual return, the expense on the fund keeps your realized gains very similar. The top 10 holdings are almost identical, and so for these two, I love them and think everyone needs exposure to growth, but you can definitely just pick one here. All right, on to this third category, and this one has been one that I've been heavily investing in lately, the more that I've done research on this. And this category is a high dividend yield ETF. Both of these dividend ETFs include only companies paying a high dividend yield and are very consistent in paying out that yield. A lot of times you may hear people advise on companies to invest in just based off of a super high yield. And just so you know, anything above 6%, 7% starts really eating at the company's bottom line. And so if they're paying that out, it's usually an introductory rate to get you to start investing in the company, but they can't sustain that long term. And since the whole idea of investing in dividends is to invest long term so that you can get passive income long term, it just doesn't really make a lot of sense to go off of only high yield. So stop doing that, y'all. Remember, as a dividend investor, you need to remember that your goal is consistency and very low risk. You can put the higher risk in the growth ETF from before, but it shouldn't be very risky in this dividend ETF or in dividend stocks in general. And these two are as solid as it gets. The first one is VYM, and that is the Vanguard High Dividend Yield ETF. This one has almost 450 companies. It has a very low expense ratio of only 0.06%. It's had an average appreciation of 10% in the last 10 years, which is so key here. This ETF pays out a solid dividend yield of 3.39%. Super solid dividend growth rate, which means essentially that even your dividends are compounding in interest yearly too. I can't say enough about VYM, and if you pick that one, that's a very solid one to pick, but this next one is my absolute favorite out of everything on the list. Now this next ETF has a current dividend yield of 3.73%, which is about 15% higher than VYM. It also has a 10-year appreciation average of 12% per year as a dividend fund. The dividend ETF here is SCHD, Schwab US Dividend ETF. Looking at the chart, VYM looks like it does have a slight edge, but what I like to see is over here, where SCHD has had a much more consistent return in the 3-year, 5-year, and 10-year range. And again, for dividend investing, I'm looking for consistency overall. There's also a whole bunch of secrets and specific reasons why I think SCHD might be the best ETF out there. I put together this video, and after doing about 100 hours of research for this video alone, I compiled it down into about a 10-minute video that you need to watch now.